Hey everybody, and welcome back to the Teaching Tax Flow Podcast, episode 101 today. We're going to keep this train going with the new trend of doing things on video and audio. But before we do that, let's take a brief moment and thank our episode sponsor.
This podcast is brought to you by Strategic Associates. Are you a high-income earner, real estate investor, or successful entrepreneur who is frustrated by having to pay $75,000 or more of annual tax liability? If so, Strategic Associates can help. Your first step to saving thousands, if not hundreds of thousands, is to contact Roger Roundy at roger@strategicag.net or by calling 801-641-2956 and be sure to tell him TTF sent you.
Hey everybody, and welcome back to the Teaching Tax Flow Podcast, episode 101. Obviously, if you're watching this on video, you can see we've been doing things a little bit different for a whole whopping one episode before this. You know, we figure we turn 100. It's kind of a milestone year. You know, it's about as many years as Chris has been practicing taxes. So, you know, we got some experience in this game. And the topic today, we are going to look at leveraged charitable giving. We have a great guest that Chris can introduce here in a moment. You know, I figure the longer I can talk, the less he can come back at me with a dig for my ball jokes, my pickleball jokes, you know, it being geriatric tennis. And of course, how long he's been practicing taxes. So I guess I'll let him say something. How's it going, Chris?
John, I would say it's great to be back, but unfortunately you're with us. It's just not Caden and myself. But we do need someone to push the buttons and make us sound good. So that's all right. We would love to have John back on the pickleball courts. I have witnessed this a couple times. And it's the kids would say it's cringeworthy, quite frankly.
Yeah.
But I think you do have some potential. All of your hockey background comes back. You know, you got in an altercation with a mature age woman down in Florida once, but that's another episode.
You know what? She got into it with herself. I just stood there and just stared at her awkwardly. Kind of like if you don't know what this topic is, right? Like leveraged charitable giving. What in the world is this thing? You know, I got to transition out of this somehow. Caden, I know you're probably like, who in the world did I commit to getting a podcast with? And before you answer that question, Chris, why don't you go ahead and introduce this gentleman here to the world?
So I am very excited about this topic and having Caden as our guest. And, you know, obviously the Teaching Tax Flow podcasting community is a very widespread community, but sometimes I'm able to bring in people that I work with on a weekly basis from our private CPA practice and shed some light on some of the tax strategies that we use within our private CPA practice and other people in the Teaching Tax Flow community that the average taxpayer is either not familiar with or never exposed to, and quite frankly, quite a few tax professionals as well. John, you know, part of what I do is I work with quite a few tax professionals, and as far as in a mastermind group and in coaching, so it's amazing how little tax planning knowledge there is out there. And that's really the reason we do this. But so we're going to talk today about leveraged charitable giving. One of the things, before I introduce our guest, one of the things I really like about this is that we know that tax laws are written to encourage and discourage certain behavior. And it's one of the three laws of teaching tax flow is that tax agencies are your involuntary business partner. And we know that people with the high W-2 wages are typically taxed at an extremely high marginal tax rate and don't get to take any deductions. So your W-2 wages are taxed as gross income, rental income, business income's taxed as your net income. And there aren't a lot of great strategies for people with a high amount of W-2 wages. So that doesn't mean that the strategy is only for people with high W-2 wages. All right, I will stop. I'm going to introduce Caden Gunnell from Strategic Associates, and we are really excited to have him. Caden, thanks for joining us.
Hey, thanks for having me, guys. I'm happy to be here.
Now, fun fact, Caden, didn't you just complete an impressive feat, a half marathon? Or
Depends who you're talking to. Depends who you're talking to, man. It was my first half marathon. It's now been 2 weeks, and I can finally walk without pain, so that's a good thing. But yeah, no, it was a good time. Something my wife and I committed to like probably only 8 months ago. We jumped into it a little quick. I was nursing a little bit of an Achilles injury because I was just an uneducated runner. If you're a runner, you know you can jump into it way too fast sometimes. But was able to finish, made it through. Yeah, it was great. So
Well, congratulations on that. And one of the things we talk about is that your tax return should be a verb, not a noun. So your tax return shouldn't be a sprint. It should be a half marathon and something you think about all year round. So, well, tell us a little bit about yourself. I know you just mentioned that you're married, and also give us a introduction to what leveraged charitable giving is.
Yeah. So I'm Caden Gunnell. I'm a junior partner here at Strategic Associates. I get to kind of lean on the credibility of my higher ups. For 15 years now, the partners here have been not really ever involved in the tax preparation, but like you've mentioned, Chris, we take a proactive approach to the planning side. And we consider ourselves a connector of solutions. Okay. So, our practice, much like Chris, we work together in helping diagnose the tax issue, and then, find the tax issue and then diagnose the solution, right? Find the type of income, what we can and what we can't do, and then implement the appropriate strategy. We've got a team who studies the tax code and they enjoy studying it. That's not me. I present, right? And I connect you with the solutions. But one of those is, as you've mentioned, leverage charitable giving, which, not to beat a dead horse, again, it's very, very powerful for our high W-2 clients, because again, that charitable donation, much like if I just donate money to my church, that's going to be what we call below the line on the tax return, right? It's on the personal side. So the income type really doesn't matter. The difference between just a standard charitable gift and one that we call that's leveraged is if I was to just take $100 and donate it to the church. Let's just say, I'm just using the church as an example. It could be anything. It could be anything. Right. 501c3 registered charity. Let's say I gave $100 in tithes. It's a 1-for-1 donation. I donated them $100. If I have proof of that, I get to put that on my personal tax return on that line item, and I get a deduction for that personal donation. Right. With leverage, we're going to take the same $100 and create a 1 to 3, 1 to 4, and sometimes all the way as high as 1 to 5. Donation, meaning I could take the same $100 but create a $500 donation. That's the mechanics on the numbers. Okay, and how we get there is something we'll continue to discuss. But that's what we're doing, is we're taking a certain dollar amount, we're leveraging it to create a bigger donation. Does that make sense in a simple form? What it is?
Absolutely. It's kind of like, let's say you were trying to buy a home, right, and you've saved $100,000, which is a huge accomplishment. And you could shop for a home and pay cash for the $100,000, or you can put that $100,000 to work and get a mortgage and increase your buying power up to $500,000. So with leveraged charitable giving, what it's doing is it's really leveraging the amount of cash that you've saved, that you've committed, that if you have a charitable heart, which many people do, they could put that to use and get a larger donation deduction for that cash outlay. So in Caden's example, let's say someone was to donate. Good. Let's use $100 just for instance. Someone donates $100. Let's assume you can itemize your deductions. Let's assume you're in the 25% marginal tax rate. Now, that could vary because everyone's marginal tax rate is different. There is no 25% marginal tax rate, but let's just say there was. And some states actually give you a deduction for charitable donations as well. So Caden, we've worked on cases where someone's in 45. Like almost 50% marginal tax rate in certain states. John, we love to throw California under the bus, but we're going to do it because itemized deductions, and they're at that higher marginal tax rate. But let's say you're in the 25% rate. What would happen is for that $100 that you donated, you'd receive, let's say, if someone's itemizing, let's say they're in the 30%. Let's just go with 30. Okay. They put $100 into their charity. That would reduce their taxable income by $100. And if they're in the 30% marginal tax bracket, it would reduce their tax by $30. With leveraged charitable giving, if they got a 5-to-1 deduction, meaning $100 goes in, $500 deduction, you multiply that by 30%, the tax benefit now is $150 for that same $100 instead of $30. Am I explaining it okay, Caden?
Yes, 100%. 100%. I'm understanding. I'm following. And so, go ahead.
So that actually, and a question for you too.
Go ahead,
No, you're good. I was going to say, here's a comment from the peanut gallery. And this is always fun because, again, I hang out with smarter people. So I get to ask the dumb questions and justify it.
Let's hear it.
So it's, for a lot of people, this may be the first time that they've heard of this, right? They're like, wait a minute. Okay, so leveraged charitable giving. Kind of get a concept what it is just by the name, right? But this is not, it's a tax strategy, right? It's not well, if I have $100 here to give to Pastor Joe, it's not me giving $100 and then him receiving 500, right? So just to clarify a little bit there, right?
Well, while we do want to clarify that it is a tax strategy, any of these one strategies, there is intrinsic value, right? These are actual registered charities. This isn't being done just to help someone save money in taxes. Anytime we're doing anything to save money in taxes, if that's our only goal, we're probably not doing the right things, right? And so that there is intrinsic value here, but again, utilizing leverage allows you to utilize less of your cash, but create a bigger gift on the intrinsic side, because there is going to be a gift that's donated, whether it's cash or whether it's an actual product, right, or a service, whatever it be. You're going to increase that gift, but then yes, you are going to, in return, increase the tax savings because you're utilizing less of your cash to create a bigger donation amount.
Right. So from a tax perspective, we've talked before about the strategy of we actually had an episode on non-cash donations. So if you have a non-cash donation, you can take a deduction for that for the fair market value of that donation. So if I was to inherit some random painting and it went up in value, and I donated that in a real donation, right? This isn't me running down to the Goodwill with a $500,000 painting without a receipt.
Right.
And that's where I would get a deduction for the fair market value. So the charity, the people receiving the benefit from the leveraged charitable giving is getting something with an economic value of 5 times the cash that was outlaid. Is that fair to say?
And it's determined via official appraisals, which is one of the rules the IRS has, as you know, right? There's going to be appraisals in certain forms and certain processes that need to be followed. But whatever the service, product, or cash, right, whether it's cash or non-cash, right, the fair market value based on that appraisal is what's going to determine your donation amount.
Absolutely. So let's talk about the donation deduction. We know, so just if you're listening right now, from a federal tax perspective, to take advantage of a charitable donation deduction, that's a mouthful, you have to itemize your deduction, right? And
yes,
it is limited though. It's limited to 50% in general of your adjusted gross income. That's in general. So in other words, if your adjusted gross income is $600,000, the maximum charitable deduction, even if you gave away all $600,000 you earned, you would only get a deduction for $300,000. You just get half.
Correct.
In the current year. Now, a guy like John, who is very charitable, I'm sure he gives away all of his income. Now, if you were to do that, it doesn't mean that the additional $300,000 goes away. It actually carries forward to the next year. So if you're in a situation, and we've had clients that this happened where, because when you're doing tax planning, you're always shooting a moving target. That their donation, they give away a little over 50% of their taxable or adjusted gross income. It doesn't go bye-bye. It just carries forward to the next year.
Yep, just to the next year. And so you can miss the mark a little bit. If you overshoot, it's totally fine. It carries forward to the next year.
And these are great to hear that, these strategies exist, right? That somebody understands them enough to obviously explain them to people, but then trying to figure out how they fit into specific situations for specific individuals, let alone comfort level with certain stuff. And I mean, honestly, even just, like everybody knows that listens to this, and Caden, we spoke a little bit earlier, I've known Chris for 24-ish plus years. And to be totally honest, maybe even like 3 or 4 years ago, I started to realize that a tax bracket is not really a thing, if you will. Tax day is not really a thing. Although my birthday is right around there, so that's enough holiday for everyone.
That's a thing.
Let's throw that into the mix. But then also like taking tax planning into account. I feel like us non-tax people, we're just kind of conditioned, if you will, saying, hey, you know what? your taxes are what they are. You can't really control them. And through tax planning and strategies and individuals like both you gentlemen, being able to blend strategies together being one thing, but then also looking at the picture and multiple people being involved in scenarios and, looking forward, looking back a little bit as well. But you really get to control, as we mentioned it, or I think Chris is famous for saying, control the relationship or own the relationship with the IRS. You absolutely can. And you're not going to end up behind bars like Capone or anything like that. This is completely within the realm of the quote unquote IRS playbook. It's just, it takes specific individuals that know it and understand it and can kind of keep you along that line. Like Caden, you had mentioned a great point as well. It's, the appraised value of something. So Chris's, $1 million painting over there, he might think it's worth $1 million, but it might get appraised at, $24.85 because, he got it at a McDonald's drive-through in the 80s. Who knows? To him, it's worth more than it really is, but you don't know that, right? So, I appreciate that, being that there is that process that needs to get followed and that there's pretty strict, it sounds like, guidelines and the processes involved. So it keeps everybody, within the bounds of, those that are set forth by the IRS.
Let's talk about with Caden some of the rules, a couple of the nuts and bolts of this type of strategy and some of the type of clients that they work with. Obviously, we work on a lot of mutual clients, like I said, but they work with clients and taxpayers all over the country. So for non-cash donations, we know that the donation amount can't be more than 50% of their adjusted gross income in general.
Correct.
And, trying to paint the picture of what avatar, of who might this make sense for. And what are typically the minimum amount of contributions as far as cash outlay that someone that would be considering the strategy has to commit?
So typically the minimums is going to be no less than about $25,000. And if we use our example of 1 to 5 leverage, $25,000 would be creating a $125,000 donation. And so we wouldn't want any less income than about $250,000 of taxable income. Because as a reminder, if you were a business owner, if your W-2 is pretty straightforward, but if you had like a gross of 500, if you got after your business expenses and deductions, lowered that AGI, that taxable income to 250, that's then when Charitable kicks in. When we talked about stacking strategies, we do help our business owners do that. We'll lower it as much as we ethically and legally can within the intent of the code with expense deductions that are available. From there, you could then do a Charitable to further reduce it by another 50% generally. Makes sense?
That's a great point. Great point, Caden. And I'm going to steal stacking. I've used the term blending different types of strategies. But yes, because this isn't a strategy that always has to live in a silo. So if you're listening to this and your W-2 wages or taxable adjusted gross, let's say adjusted gross income, because it could be any type of income, is $250,000 or more, and you do have a charitable heart, and this is something that you might want to consider, because at that point, again, you can, especially if you're in a state that allows for a itemized deduction for a donation, then this is something you want to consider, because you would see a good benefit from it. And so if someone does want to partake in, a leveraged charitable giving, let's say in 2024, is this something that they would need to do every year indefinitely, or is there what's kind of the time frame for that?
When it comes to the year that you're trying to get the benefit, I should say, or the year you're trying to donate, right? Yeah. Just has to be done like most strategy. The money has to be moved prior to the year's end. Okay. If you wanted to repeat it year after year, with a lot of our strategies, it's you donate and you're done, right? There's going to be forms you receive to prove the donation, gift receipts. Some of them distribute K1s. Whatever it be, though, that's going to be given to you before it's time to prepare your tax return. So if you wanted to utilize the same strategy the next year, our firm is constantly finding these opportunities. At this point, we're actually having them brought to us to where we vet them out and we get super comfortable and super confident before we're ever going to utilize it as an option for a client, right? But yes, this is something that could be done year over year.
Right. So it's something that you could do each year, but you don't require, we've had some business owners, And I'm not saying that, defined benefit plan isn't a bad strategy. It definitely can be a good strategy. However, that type of strategy typically is a multi-year commitment, where this is a year-to-year commitment. And
Absolutely.
And there's different, and you made another good point, Caden, that if you're thinking about leveraged charitable giving, if you work with Caden and myself, or don't work with us, make sure that whoever you're working with, or you're even trying to do something on your own somehow, it's so important to have that substantiation. And what that means is that those are documents that are provided to you at tax preparation time that substantiate the deduction legally and ethically, meaning qualified appraisal, or that underlies maybe a K-1 form or a donation receipt. It's not that this isn't something you should be doing willy-nilly on your own, just slapping a number in on your tax return. The IRS is getting extremely more sophisticated, and
Yes.
they are using AI, and they are using technology to find anomalies. And, if you do get examined, you want to make sure there's nothing wrong with taking a donation that you're entitled to. Just make sure that you have the proper documentation. Can you kind of tell us about what are some of the standard, as we kind of come to the end here, what are the standard type of documents someone should expect if they're going to get into leveraged charitable giving?
Absolutely. Yeah. If you're going to get into leveraged charitable gifting with a product that we connect someone to, typically you're going to expect to see a K-1 if it's via a raise for a partnership that's actually being utilized to purchase the product, as well as a gift receipt. You're always going to see an official gift receipt that goes over how the fair market value was determined. Those are the number one things I would look for. There's a few other tax forms there's actually a list. It just depends on the opportunity, but those are two of the biggest ones. If we're dealing with cash donations, not as much, because fair market value of cash, it's pretty easy to determine. So it's really just going to be gift receipts in that situation. But yeah, with non-cash donations, look for typically to see a K-1 from the partnership, as well as the gift receipt itself.
No, we really appreciate it. Go ahead, John. I'm sorry.
No, you're good. And one more question too for you, Caden. So obviously now we're talking here, it is September of 24. Say I'm just hearing about this. Say I do meet the qualifications of what we had mentioned, $250K or above of taxable income. And say I just have been giving throughout the year. Say I'm up to, we'll just call it 20,000 throughout the year, or 15,000. Again, just hearing about this. So is there anything that I might need to do different to meet the qualifications of this? Say I'm like, you know what? I've been giving all year. Crap, I wish I heard about this January 1. Or is it really just based off of what you said? As long as there's proper documentation in place, this could be something that started wherever throughout the year. Just
you can start where you're at. My advice would be you start where you're at. And if it is something you're just hearing about, and the beauty is we do have, we're talking in September. It's now September. That is crazy to me.
Right.
But at least we're not talking in November, December, when some of these programs do oversubscribe. Some of them fill up. And that's not just a do it now tactic. That's just the reality. And so if this is something you're hearing for the first time, you feel like someone that does, you are charitably inclined, and Chris is helping you out especially, let us know. We'd love to look at your situation and find out if charitable giving is right for you.
Absolutely. I would say, yeah, as we put a bow on it, if you are charitably inclined, and you're at an income level of $250,000 or more, even if you're a sliver less, remember that deduction can carry forward. Definitely, inquire, and it's something that I agree with Caden. Unfortunately, we've had people that wanted to move forward with tax strategies and were a little too hesitant, and the boat left the shore. And unfortunately, some of these strategies do get, fully subscribed. But yeah, this has been a strategy that we've had people in our community use and use it happily. So, Caden, thank you so much for coming on. And and we'll leave all of your contact information and some ways to reach out to you in our show notes and always in the Teaching Tax Flow community.
Yeah, absolutely. Thank you, Caden. I appreciate it. Yeah, the best testimonial to this, right, is I knew the title of this show. I knew nothing about it, in full transparency. And now I feel like I can go on the street corner and tell everybody about this thing. So You guys did a great job of explaining it to really from both sides of the fence. So I appreciate that. I know our audience will as well. And Chris, to kind of echo what you said as well, we'll put all the contact information as well as some other resources in the show notes. So on YouTube, you guys, anybody that's watching this, it'll be in the description. Spotify, Apple, anywhere you listen to podcasts, you can listen to the audio component of this. It will be in the show notes as well. We do have to cut it short because Chris has to get to a hair appointment. That's the quiz for anybody that's actually watching this. You'll get the joke. But until next time, as we close it out with, we will see everybody back here next week, roughly about the same time, but a different topic here on the Teaching Tax Flow podcast.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.